Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, where we help you understand the closing action on the D Street. Well, it's turned out to be a good day. 23,134 thus far as the Nifty is concerned. We are 177 points higher and we are holding on to above 23,100 for a fairly good amount of time. And although there has been some choppiness through the course of the day, but largely we are much better off and we picked up pace from yesterday's gains as well. What's also encouraging is that the broader markets are also reviving. Remember, yesterday, the key pain point in the markets, despite the Nifty ending in the green, was the broader market sell-off, especially the small caps. But today, there is a 3% recovery as far as the small cap index is concerned. We are at the high point of the day as far as the small cap 100 index is concerned. And this is the better of all the sectors that we are also seeing. Even the mid caps are also up by about 2.2%. Among the other key sectors, barring the FMCG sector, rest all of the sectors are actually in the positive zone, with realty again carrying on with the momentum since yesterday, about 3% higher in trade. IT stocks are doing very well, 2.5% uptick for this one. And you're also seeing pharma, metals, autos also drive in the positive zone today. The top movers on the Nifty in the last half an hour of trade are BEL, that's been holding on to this position since morning, 3.5% higher. You have Bajaj Auto, that's up by nearly 3%. Earnings factor coming through. HDFC Life has been buzzing higher, and we've also seen Bajaj Finance as another stock that's been among the top movers on the Nifty. On the lower end, however, you will find spots like Bharti Airtel, Asian Paints, BPCL, Britannia HUL, just about a handful of stocks that are actually lower in trade, but large part of the breadth is towards the positive side today. Even the PSU index is up by about 1.7%. You have BHEL that's rallied post earnings, 6.5% higher. You have REC PFC, the erstwhile favorites coming back into 3.5% up for this one. BEL is doing well. You also have the railway stocks also doing very well at this point. In the F&O space, you have KPIT Technology, again earnings factor that's actually doing well. CG Power is another one that's also buzzing in trade. But let's welcome our guest on board to really understand the market trends, the underlying currents, and what can we expect going forward from here. We have with us a very special guest joining in. We have Mr. Sharad Awasthi joining in. He's from Smiths and he's been with us for many shows prior also, and he's been sharing with us a lot of insight, and this is the absolute good time to have you, sir. Warm welcome first up. Right ahead of the budget, we would want to understand what exactly do you believe that this time around the markets should expect. Will it be a market focused, a growth oriented budget? Do you think there will be enough and more triggers to get the markets back on track?
Thank you for having me on the show. Yeah, I certainly think that this time around, maybe after a hiatus of around 4 5 years, we will have a budget that might be a bit more exciting than what we have seen in the last 4 5 years. So there could be a mix of some tinkering on the income tax rate, something on the GST side. The focus largely being spread across reinvigorating capex as well as consumption. So I think it will be a mixed budget where you have something for everyone. And I think the tax cuts is something that we have been waiting for a long time. Inflation is already eating into a lot of the middle class. Though, yeah, but taxes are higher, means the total collection is higher for the middle class or for the individual taxpayer. But I think that is something that is acceptable in a developed economy, but in an economy where you are still doing with $1,500, $2,000 per capita and you want to expand it at a rapid pace, I think we have there should be some time gap where the individual tax collection should be higher than the company tax collections. Till such time, I think the focus should be on spurring consumption and for expanding the tax base also, I think tax cuts. So I think it should be a wholesome budget, tax cuts, some rate rationalization, some duty structure corrections, and obviously the focus would remain on capex, capital formation basically.
Okay, got that. If I have to ask you, Sharaji, are there any pockets or sectors that you believe the budget will focus more on, and therefore it is important for investors to really keep their focus on particular sectors? I mean, there has been an absence of pre-budget rally. Usually we see defense, PSUs, railways, all of these sectors get a lot of action right ahead of the budget. It's been absent this time around. But do you think post the budget at least there will be some focus, and therefore initially only before the budget one can focus on some of the sectors to build positions?
See, I think the basic difference would be that, defense or railways, defense particularly as well as railways. I think most of the stocks got listed in the last 2, 3 years. And
Yeah.
prior to these rallies or prior to earlier budgets, they were trading at much attractive valuations. Most of them were trading at what, 10, 15x, barring maybe a BEML that's always traded at higher valuations. But if you look at it across the board, I think most of the railway companies, most of the defense companies, post listing in the new issues, they were largely trading at 10, 15 times. This time around, what you are looking at it, they might be on an average trading at 25 to 30 times forward right now, most of them. So I think that is one of the reason why you can't find value there. So maybe that is why a lot of buying is absent, and there has been a lot of burnout in these cases also, because they saw a very stupendous rally in the current calendar, in the last calendar year,
Hmm.
particularly March, April onwards. Most of them rallied, 3, 4x, and then they corrected, gave up around 1, 2x of this. So they're still double from where they were maybe, at the beginning of last calendar year. But still from the highs, they are down on an average 30, 40%. So that also dampens sentiment. So I think both these things are playing out. One, the valuations right now are not as compelling for defense and railways as they were earlier. And the recent correction is a bit of a mood dampener, where maybe people have finally realized that it is not going to be as linear as they were expecting it to be. But I think for both sectors, railways as well as defense, the big trigger would be the export opportunities that come up. Something like an RVNL can have huge opportunities on the export side.
Okay.
On the defense side, I think most of the companies will have big opportunities on the export side.
Hmm.
And for defense, particularly, I think the moat is very strong. I think the offset clause will continue to improve their earnings at the domestic level as well. And the big kicker to forward numbers could come from export opportunities that happen even today. Most probably, we have some additional export orders for the BrahMos missile.
Hmm.
So I think this is going to continue for some time, and it might not be very linear that you see it happening every now and then. But gradually, if some big export orders culminate into wins for these companies, I think defense could be one space where across the board you could see a lot of improvement.
Okay, fair point. I also wanted to get a sense on the markets per se from you. We've noticed these 4 consecutive months of painful period go on. At least on the broader markets, we are seeing that they are nearing a bear market territory as well, with 15, 17% going away already. Nifty particularly is down by about what, 34, 3,500 points from its all-time highs right here. Last few days, we are again seeing some bounce return in the markets. Do you really believe that the bulk of the pain is already out of the system, or there could be some more to go, sir?
No, I certainly believe that the bulk of the pain is most probably behind us.
Okay.
From here on, largely we should see an improvement, because generally markets don't fall or rise more than 10, 12% on a standalone basis globally. We are all synced. Occasionally, one market might do something strange,
Hmm.
but generally you don't have such generic movement of more than 10, 12% across one market.
Hmm.
And I believe if you look at the global context, we probably are the only market that's corrected a bit. Prior to that, we did not see any correction when other markets did correct. So I think now it has more or less balanced out over the last 5, 6 months. It is perfectly balanced out. Growth rates for us will be better than the rest of the world. And I think broader inflow should also start once the lower rate cycle is more or less affirmed, and lower inflation is also affirmed, particularly in the developed nations, particularly US. So I think as that happens, there is a high probability that the FII outflow that we have been seeing, that will also reverse. And I think that should get us again on the sweet spot. And yes, to answer your question in one line, I certainly think that most of the pain is done, and from here on, we should expect a very smart recovery. And as I said, budget could be one of the bigger triggers that could play that out.
Absolutely. Apart from the budget, from last 2 days, again, we are focused on how the RBI came out and talked about liquidity measures that it's taking. And that was being seen as a fresh trigger. That's how we saw the Nifty bank inching higher. The rate sensitive sectors also moved up again. Are you seeing this step as a precursor to the interest rate cut that could probably come in on February 7th, once the RBI gets to meet for the next policy review? Something that was still under question a little while ago. Now, does it seem to be more realistic to expect a rate cut happening? Will that be a fresh trigger that the markets are waiting for?
Yeah, I think that could be one thing that could materialize, over the next few meetings, MPC meetings. The sooner the better, but I think largely it will be, in kind of in consonance with what happens in the US markets, particularly. The currency the movement has been another problem area for us for quite some time now. Though in comparison to most currencies, maybe we are in the top quartile in terms of depreciating the least, but nonetheless, we have depreciated in spite of the bond inflow story, etc. So I think those two headwinds are something that the RBI would like to cater to. And regarding this liquidity infusion, I certainly think it's a precursor that maybe they are more aggressively looking at reinvigorating growth rather than just focus on inflation. And with the fresh supplies coming in, gold, silver more or less stabilizing, there is a high probability, that as the higher base effect kicks in, you will not see that much of an inflationary problem in terms of the percentage levels. And particularly food inflation subsides post winter crop arrival. I think there is a high probability that it comes down even in India. So all culminating together, I think there is a high probability, that interest rates go lower. And with this liquidity infusion, I believe the RBI's trajectory is also very clear. Whether they do a small cut on the basis of a standalone basis without really waiting for the US to move, that is something we will have to watch. But right now, the indications seem to suggest that maybe they are looking at a rate cut sooner than later.
Okay. Understood. Sharad ji, apart from this, I wanted to also take your view on the broad earnings that have come through. We've seen a large part of IT earnings come in. We've seen some banks also report their earnings as well. Autos have been reporting their earnings now too. Overall, what's the sense that you're getting? Before we had started off our conversation, even before the earnings started, we were kind of trying to understand, will this be another quarter of disappointing earnings largely? How has it played it thus far? What's your expectation for the rest of it?
See, on balance, when you look at it, I think throughout the various sectors, whatever numbers have come out, largely the outperformance or the better numbers have been larger in numbers. Most companies have reported better numbers. I think the average ratio could be, 3:1 in terms of companies that have reported positive numbers vis-a-vis company that have reported maybe a poor set of numbers across sectors. And I think banking and NBFCs has been one surprise sector where there was too much nervousness regarding provisions, the MSME problem, the microfinance problem. But if you look at the numbers, though, they are still not huge. For banking, maybe we have the highest numbers vis-a-vis the total basket, the numbers that have been reported. So I think we have the largest sample area there. For the rest of the sectors, I think the number of companies that have declared results vis-a-vis the total basket is still very small, and so it would be hard to form an opinion based on this smaller sample size. But till now, whatever has come up, it seems to suggest that it is largely positive. For banks, most of the numbers have come out, or at least 50% of the numbers have come out, and from there, the inference you can make is that maybe the problem is not that big as much we were thinking of it to be. Even on the NBFC side, it is probably not as bad as we were thinking about it. So maybe the small finance banks or the microfinance lending ones, they could see a smart recovery from here on.
Okay, got that. Well, apart from this, Sharadji, also wanted to understand, like I just pointed out, that it's the mid and the small caps which have gone through an excruciating pain. 15% lower for the mid cap index from its all time high, near 18% of a loss for the small caps from the all time high. Of course, today there has been some recovery, so we'll have to check what are we at right now. But some more pain, and probably small caps will enter into a bear market territory. How are you approaching these two spaces? A large part of retail investors' portfolios that are exposed to these two sectors are bleeding left, right, and center. What are you advising those clients?
I think the one simple thing you should be ready when you're investing in small cap and mid cap stocks is volatility. If you're investing into small and mid cap stocks, you expect a 5%, 6% kind of alpha on a diversified portfolio. And the type of appetite we have built over the last, post COVID era, where a lot of caution has been thrown to the wind, and the retail investor has been very aggressive regarding mid caps and small caps, and they've made good money out of it. So I think when you look from the top, it might look very excruciating that you're losing, on the index level 18%, maybe on a stock level, the most fancied names will be down 30-35%. So it's very excruciating, and it happened in a very short span of time. So that's even more painful. But my simple advice would be when you invest into small and mid caps, be ready for 30-40% kind of drawdowns. Identify your stocks carefully, and even with a 30-40% drawdown, I think you should not be very perturbed. Ideally, if you buy it over a staggered manner, it's much better. But I think that's advice in hindsight. In the current scenario, if you have stocks where you have confidence on the fundamentals, maybe they're down by 30-35%. For mid caps, small caps, I think that kind of correction is a given when you have gone up, 3, 4, 5x over the last, 2, 3 years, particularly over the last 2 years. So I think it's a very normal correction. And in some cases, the valuations were problematic. You were maybe discounting too much of the future. And then occasionally, when the sentiment turns, it's very normal for mid caps, small caps to correct by that range. So whenever you buy into mid caps and small caps, come into these stocks with a preconceived notion that a 30-35% correction can happen, especially when you're buying at peak, after a 2-3 year kind of bull run where they've grown by 3-4x. So there is a possibility that you have a 30-35% drawdown. But if the stories are strong, if you have conviction, I think these stories could do well over the next 1.5, 2 years. And for mid caps, small caps to recover 30-35% drawdowns is not a very big deal. One good result, you could be looking at, two upper circuits, 15% upsides, or one good report, anything, one good news, one big acquisition, because these are not large cap F&O listed names where a lot of institutions participate. So the recovery side can also be very fast. Though it looks very steep when you have gone down by 30%, you are looking at a 50% appreciation to just recover cost. But in mid cap, small caps, I think right now the condition is if you have it, extend your horizon. If you were thinking of say 1 year, extend it to 1.5, 2 years to start with. And I think it should not be very difficult for good growth companies to catch up once the numbers start improving, like microfinance and MSME financing is a particular example you could look at. Companies like IdeaForge have corrected a lot. So these are examples, these are strong businesses. They might be going through a lean patch on the frontline names, UPL. So they might be going through a lean patch, but once the recovery phase starts, it's very hard to predict when. But it might be get delayed by say 3 to 6 months. But once it starts, it will be good enough to recover most of your lost, time value as well as money value. So expect a 30-35% depreciation in small cap, mid caps when you invest. And if you have conviction, I think continue to hold over the next 1.5, 2 years. Most of them should give you a very strong recovery. And most probably you should be in better profits.
Okay, got that. Now let's delve a little deeper into some of the pockets now to understand your strategies there, sir. We'll start off with the rate sensitive sectors since we talked about the RBI and the liquidity measures and the rate cut opportunities. How are you looking at banks and financials at large, and then realty and auto?
See, banks and financials, I think, yeah, we would continue to bet on them. I think Kotak, the numbers have been very good, though not a typical direct play on the lower interest rate trajectory. I
Yeah.
think most of the PSU banks or the the big treasury books could be much more beneficial out of that. But, treasuries have not been doing much for most of the markets. Most of the banks. So I think once that starts to contribute and advances also normalize, which have not done much maybe over the last 2-3 quarters, all culminating together, it could be very positive for banks. So within the private sector banks, I think Kotak is a good idea to bet on. There could be some re-rating in the price to book multiples it is trading at. Once the business normalizes, the transition, the way they are doing it, it starts to show numbers. I think there is a high probability that you could have some strong re-rating there. HDFC Bank could continue to be on the list. I think at these valuations, you are still looking at maybe, 400-500 rupee kind of upside from current prices. And once the merged entity starts to show up the numbers with respect to the capex they are doing, that could be beneficial. IndusInd Bank at these valuations, again, something that is impacted by the MSME and microfinance part of it. So I think that's a very attractive bet. You could be looking at targets of around 1500. So these are the three private sector banks you could be looking at. On the public sector banks, I think if you want to go safe, go with the big ones. Things like an SBI, etc., could do good.
Sure.
And smaller names, I think UCO Bank, Union Bank, these are good names to look at, trading at what, 0.7, 0.8 times. And most of the small finance banks, I think something like a Jana Small Finance Bank, AU, ASAF, These ones could show some very smart improvement. Fusion have been recommending for some time. It's corrected a lot even after I recommended. So I think that is one story that could also recover very smart. Maybe a Spandana Sfurti or a Credit Access Grameen also. So I think as a theme, this basket looks very attractive at these valuations, and most probably, in the times to come over the next 1.5 year, as the recovery plays out, or the dip is not as deep as we were expecting it to be in terms of the credit cost or the NPA pile up. So I think these could be names that could do very well.
Fair point, sir. Let's look at the market spotting as well. Broader markets are throwing up some interesting names. There are many pockets that are buzzing. Inox Wind has hit a 20% circuit today. You also have fertilizers, chemicals, specialty chemicals names doing well. Ami Organics is at a 20% circuit. You have Chemfab Alkalis at 18%. Deepak Fertilizers is up by about 14.5%. These spaces look interesting. Neogen Chemicals is up. This has been a space which was wavering earlier, but suddenly it's come back into action. Anything that you'd like to suggest here? What's behind this fresh move? Fertilizers, chemicals, specialty chemical space?
I think particularly fertilizers, Deepak most probably had announced results today, so that's the
Yeah.
purpose. But at these valuations, I think maybe most of the positives are priced in. They have a lot of capex to undergo over the next 2-3 years. But I think at these valuations, maybe Deepak, is fairly squarely valued. Unless and until fresh triggers emanate from the capex, they do some improvement in the margins, etc. But on a standalone basis, I would think that maybe fairly valued. On the wind energy and solar energy side, I think post Trump there has been a lot of correction. Like you were talking about Inox Wind. So what are we
Yeah.
expecting? Next 2 years, the earning flashes up from 4.5 to around 9 rupees. It's still available at what 135, 150, 150, 160. So I think for this kind of story, 15 kind of multiple 2 years down, I think it could easily get 20, 25 times. So maybe you're looking at something which could go up to 200, 250 over the next 1.5, 2 years. So that's a decent upside from current levels. Similarly, Suzlon, I think after this correction does make a lot of sense to stay into
Okay.
it. The
Okay.
type of capex they are doing, it could help them. Sterling Wilson Solar has corrected a lot, so I think that would be a good name within the solar part of it. Even Borosil Renewables could do very well, I think. But the flip part could be, that the international business might suffer a bit because of the Trump exposure. But for Inox Suzlon, I think it's largely a domestic business. It's not much international. So these they don't have much of international orders. It's largely been India-specific orders. So I don't see any kind of slowdown because of Trump coming in. So offhand, I think Inox Wind looks like an excellent bet for 200, 250 over the next 18 to 24 months. So that makes a decent upside. So this could be a good idea to play on.
Fair point. All right, 5 minutes to go before we wind up today's edition and the markets as well. We've had a fairly good day, 219 points higher, now at 23,176. So no complaints right there. And we've had several pockets that are buzzing too. What are the chances, Sharaji, that post the budget we will try and attempt to retest our highs of say 26,277 on the Nifty? Will we be able to retest that? Is that a possibility?
Uh, Depends post budget when. I think in a post budget rally per se, uh, one should not expect that kind of optimism. Maybe 1,000, 1,500 points. But over a period of the next calendar year or this calendar year, I certainly think we will be scaling those highs and much beyond those levels.
Okay, wonderful. Well, always good to speak to you, Sharaji, to get all those fascinating insights on the markets and see your presence has lit up the screen right again. So we'll be hoping that you'll be coming back very soon to help us see that the markets are in large part of green and our portfolios also turn greener when you come in. So thank you so much for coming in on the show with us. 222 points higher, 23,176 clearly on the Nifty. The Nifty Bank up by 0.6%, but it's the benchmark that's outperforming. What's even outperforming the benchmark index? The broader markets. Look at the mid-cap 100 index and the small cap 100 index. Mid-caps is up by about 2.2% on the 100 stocks, 52,711. The small cap 100 index is up by 3.3%. It's Well, it's recovered yesterday's losses and partly the losses of day before as well. So we are seeing this fresh bout of rally. The renewable energy space, fertilizers and chemical space, that's rallying in trade. The real estate stocks are doing very well. Look at the index, it's the top moving one, 2.7% higher. IT stocks are doing very well, of course led by Infosys and all the heavyweight counters, and even stocks within the mid caps like KPIT Tech that have their earnings to thank for this move as well. Persistent is up by 6.7%, Emphasis up 4.5%, L&T Technology, LTI Mindtree, Coforge, Infosys, all of them in fine fettle. I mean, it's a good day to be talking about markets after a fairly long day. We also have, it's an all across broad based rally that we are looking at, and that is a rare sight for this entire last few days that we've been looking at the markets. So you have the heavyweight counters that are doing well, you have the broader markets that are doing well. All of those pockets that were absolutely lying in slumber have come back. Fertilizers, chemicals, specialty chemicals as well. In the broader markets, look at the kind of gains. Inox went 20%, Ami Organics up 20%, Sirma SGS Technology is up 20% as well. You have even stocks like Hindustan Motors, that's up. You have Skipper, that's also buzzing 13% higher. Deepak Fertilizers earnings factor 330% of a surge on the profitability has propped the stock higher, almost 14%. PG Electroplast, Car Trade Technologies, even the new age tech space after a long haul now buzzing in double digits. You have Voltam Transformers, all of these stocks really coming back and coming back. Howlinde India, Inox Green Energy, this is the space that is Lee Travenues, that's Ixigo, travel tourism space stocks also buzzing in trade. Those are the interesting names that have actually found favor with the investors and the markets in trade today. Top movers on the Nifty, BEL, Bajaj Auto post earnings, HDFC Life Insurance, Coal India and Hindalco. On the downside, however, Bharti Airtel, Asian Paints, Britannia, HUL, BPCL, some of the stocks that did not do well. F&O space, KPIT Tech, top mover 9.5% higher, CG Power 8% higher, CAMS also up by in trade, Laurus Labs, you have IEX, all of these stocks truly buzzing in trade. And how? Alright viewers, we'll start wrapping up the trade now. 23,178 for the markets, and we hope that this momentum continues to take shape. But remember, tomorrow will be the expiry of the series, and that's what we will have to see as to whether we will have a positive close on a series which has been rather weak and probably the worst January series that we've seen in a long time for the markets as well. Wrapping up at that, but do stay tuned on to Business Today Television. We'll continue to get you beyond the markets coverage on what can you expect in the upcoming union budget as well. Stay tuned. We have a lot more lined up for you on your screens.
Good morning, ladies and gentlemen. We continue our deep dive into quality third quarter earnings that has been reported by Corporate India, and in this case we focus